Many investors begin with enthusiasm, convinced that a few astute selections will lead to quick wealth. They pore over headlines, monitor price fluctuations, and chase every speculation as if hidden insights await them. This relentless quest for patterns breeds overconfidence and excessive trading that diminish overall returns. Current prices reflect the expectations of countless market players who react to available information. When everyone rushes towards the same hot trend, the competitive edge vanishes before they can capitalize on it. The perception of skill often stems from fleeting strokes of luck that eventually revert to market averages. Constantly trying to outsmart collective intelligence incurs high costs, taxes, and lost opportunities. A wiser approach begins with acknowledging that randomness heavily influences short-term market fluctuations. Once this reality is embraced, attention can shift from predicting market direction to ensuring long-term involvement. This video draws inspiration from the book A Random Walk Down Wall Street by Burton Malkiel, so subscribe for more evidence-based investment insights. The market operates as a massive information processor, integrating opinions, news, and analysis into pricing. Each buyer and seller makes decisions based on varying assumptions, yet the overall consensus shows in the market, quote, "Fresh data, corporate performance updates, or shifts in policies promptly change this equilibrium as participants respond." Because all investors have access to similar information, consistently outperforming the market becomes highly rare. This ongoing process illustrates why even skilled analysts often disagree, yet they collectively maintain prices close to fair value. Randomness emerges when emotions and unforeseen events trigger short bursts of irrational movements. These price swings can entice investors into action, but most reversals happen before positions can be adjusted. The key lesson is that preparing for a range of possible outcomes holds more value than attempting to predict the exact future. Achieving long-term success relies more on building a robust structure and exercising patience than on seizing the next surprise. Maintaining diversified exposure while accepting uncertainty should be the foundational strategy for consistent progress. Research consistently shows that most actively managed funds fail to outperform market indexes after accounting for fees. Instances of outperformance tend to diminish over time because initial success attracts more capital, which dilutes flexibility. Many managers engage in frequent trading, pursuing quarterly rankings and media visibility instead of sticking to a disciplined strategy. Data indicate that consistency is far more significant than brief periods of exceptional gains. Survivorship bias obscures the many funds that have quietly closed due to subpar performance. Even those who excel in one decade rarely replicate that success in the following decade. A handful of long-term achievers illustrate that skill is attainable, but remarkably scarce, compared to the assertions made. For typical investors, aiming to emulate overall market performance is a more reliable route than attempting to pick individual winners. Index funds simplify the investment process and keep costs low, eliminating the need for prediction. If this investment philosophy resonates with your objectives, subscribe to discover actionable strategies to implement it. Diversification ensures that your risk is spread across numerous assets, minimizing the effect of any single investment's failure. Indexing automates this principle by allowing you to own a slice of the entire market at a fraction of the cost. Such funds deliver average results that even many professionals struggle to consistently outperform. Diversification is effective because individual errors tend to balance out within a well-structured portfolio. This approach turns unpredictable outcomes into a more stable and reliable performance over time. The critical factor is broad coverage that spans various industries, countries, and asset classes. Thanks to simple index funds, this investment strategy is now accessible to all investors, not just large institutions. The outcome is steady compounding, paired with reduced decision fatigue and fewer emotional roller coasters. Over the long run, this understated approach often outperforms most attempts at making bold, quick moves or timing the market. If you're interested in cultivating consistent and compounding wealth, subscribe for in-depth resources on evidence-based investing. Every investment involves some level of uncertainty, but risk only becomes detrimental when it is misunderstood or mispriced. Returns are a reward for accepting variability, not for trying to dodge it. Behavioral biases can distort your perspective, causing fear of normal fluctuations while chasing unrealistic gains. Reacting excessively to temporary losses often leads to selling at low points and buying at high points. Your risk tolerance and time horizon play key roles in determining the right asset allocation for you. Younger investors can have a higher stock allocation, while retirees should prioritize stability with bonds and cash reserves. Adjustments to your portfolio should reflect life changes rather than trending headlines or social media noise. Measuring progress against long-term goals rather than daily market prices help keep emotions in check. Maintaining emotional control turns market volatility into a manageable aspect rather than a disastrous flaw. Those who cultivate this mindset are more likely to accumulate consistent returns, while others react impulsively. Begin by defining your investment goals in terms of life outcomes rather than short-term performance metrics. Create an asset allocation that aligns with both your risk capacity and emotional comfort. Automate your contributions and rebalancing to eliminate the temptation of trying to time the market. Periodic rebalancing helps restore your desired allocation by automatically selling high and buying low, free from emotional bias. Utilizing tax-advantaged accounts enhances compounding by mitigating the impact of annual tax liabilities. Focus on low-cost index funds or ETFs as the foundation of your investment strategy, while using minimal, speculative positions. The system must remain functional even when predictions fail, ensuring it doesn't rely solely on accuracy. Consistent savings, patience, and reinvested dividends gradually create significant wealth. Fewer dramatic decisions lead to a greater chance of achieving financial independence. Over time, consistent efforts surpass occasional brilliance that may crumble under pressure. Markets often lose rationale, oscillating between greed and panic in repeated cycles. Bubbles develop when enthusiasm detaches prices from true value and burst when confidence diminishes. Crashes penalize leverage and speculation, but favor those who continue to invest consistently. Each generation assumes this time is different, yet the underlying patterns persist with fresh terms. Staying rational means getting emotionally ready for downturns instead of trying to predict them. Maintaining cash reserves and diversified allocations prevents the need for forced selling during turmoil. Recoveries typically initiate quietly, even before most investors regain their confidence. Discipline during volatility transforms fear into opportunity through ongoing contributions. Long-term data consistently indicate that markets reward patience far more than precision. For rational investing insights grounded in evidence, subscribe and stay steadfast through every market cycle.